strategy is best? We now have 3 strategies that are part of our toolbox. So which ones do we go to in certain conditions? So I put together a quick outline. If you are strongly bullish, individual calls, the long call spreads, those are going to be the most aggressive routes to go. Those are going to give you the biggest profit potential, but they're also going to come with the most risk. A short put spread is still a valid route to go as well. It's just if you have a strong directional opinion, the short put spread is going to have a limited profit potential. So you may not have as impressive of a return. So I just don't want you to be disappointed by that. If you're strongly leaning one direction or the other, the long options are going to give you the bigger bang for your buck. If you are moderately bullish, so you have a directional opinion, but you're not as confident, the vertical spread's by far the better route. Okay, they're going to lower the cost in the trade, lower the risk on the trade, and still give you the ability to make money from a directional move. On the flip side, on the bearish side, if you are strongly bearish, again, long put spread, most aggressive route you can go. Big profit potential is available. It also just comes with some additional risk as well. The short call spread, definitely valid. You just have to know that you are giving up the home run profit potential in exchange for that higher probability of success. And then if you're moderately bearish, vertical spreads, and a lot of times people, they think they're giving up a ton by using the vertical spreads. You're not. You're still giving yourself a really nice profit potential. So a lot of times people say, I don't want to trade the vertical spreads. They're not aggressive enough. You don't want to fall in love with one strategy, right? Don't use long calls and long puts exclusively. Don't use credit spreads exclusively. Use them together. And that's really going to lead to the best results over time. I also included a section here for volatility plays. If you get into a very high volatile market, like we've been in for the last month or so, selling the credit spreads are going to be, in my opinion, the best routes to go. If you're going to buy calls and puts, you do have the ability in high volatility to use the weekly options, use those shorter duration options that we talked about yesterday. In a low volatility environment, you're going to be better off buying the vertical spreads. You're going to be better off using the monthly options. Going farther out in time is going to better reflect the current market conditions. So I love to use the weeklies. I use weeklies more so in a more volatile environment. So here's just another slide that just simplifies it even further. The most conservative route that you can go, the credit spreads. I know it goes against what a lot of people hear initially when you start to trade options, but the credit spreads will give you the lowest risk. Yeah, they also come with the lowest reward, but they give you the highest probability of success because you have those 5 ways of making money on the trades. A little bit more conservative in the middle section there, the debit spreads. They do typically lower the cost of the trade by 30 to 50%. You do have a lower reward potential, so you have to know that going in. You're still going to make money. You're still going to have a really nice return. If I compare them side by side with a debit spread, if you compare it to a long call or long put, you're typically going to have between 50 and 80% returns on a winning vertical spread trade. With a long call or long put, you're going to be closer to 100%. So there is a difference there, but you also get a drastic reduction in the cost of the trade as well, which is really nice. And then again, the most aggressive route to go, even though a lot of people don't understand this, the long calls and long puts, they're exciting, but they're also the most aggressive route you can go. They have the most profit potential with the most risk. And you only have one way of making money on those trades. So you just know what you're getting yourself into. That's why a lot of retail traders fail to hit their profit goals, and they struggle because they don't fully understand how the strategies work. A lot of times people will start trading long calls and long puts. They don't make money, they lose money, and then they end up blaming the markets. They blame the system. When in reality, it doesn't mean that long calls and long puts are bad. But if you're not using them correctly, if you're not using the proper strike prices, if you're not using the proper expiration cycles, then you're gonna face an uphill battle. Whereas everything that we've walked through the last day and a half is looking to stack that deck in your favor.